As we move into August, we begin thinking about the end of summer and the upcoming back-to-school season. Any road trip to a destination is composed of sights to see along the way. In this video, we'll look at peaks and potholes on the way to our destination of 3,000 in the S&P and 300 in the SPY. We're also going to take a trip back to 1954 to look at similarities and differences between bull markets. We open with a summary of this week's economic data and interpretation. This was a big week for economic data, and the outlook for the economy remains very strong. The most awaited report was the non-farm payroll report that came out this Friday. The number of new jobs created was lower than expected due to an adjustment to retail jobs to reflect the Toys R Us bankruptcy. As we'll see in the next slide, the market saw through this adjustment and closed higher. Now we'll look at our week in review, where we look at the headlines and how they moved the market. On Monday, the Nasdaq posted its biggest three-day loss since March. On Tuesday, stocks closed higher on trade optimism. On Wednesday, overnight news again raised trade fears, but the Nasdaq rose as Apple rose to $1 trillion in market cap on strong earnings. On Thursday, follow-through in the tech sector lifted the market. On Friday, the market initially fell on the non-farm payroll report, but saw through a one-time adjustment, noting that the overall trend was higher and closing up for the week. For the week, the S&P was up 0.69%, and the month and year-to-date statistics are provided at lower right. We'll begin our road trip with a look at the roadmap we made back on May 11th. The charts and the evidence still support a target of 3,000 in the S&P 500 and 300 in the SPY ETF that tracks the S&P. Any road that's fun to drive will have some twists and turns along with sights to see along the way. Our first stop is new heights on the monthly charts of the major indexes. Looking at a monthly chart of the SPY through July, it's hard to argue that a new closing high isn't bullish. The January close was 279.52, and in July we made a new closing high of 281.33. The 10-period moving average in blue and the 12-period moving average in red also show a positive slope with good spacing between them. Looking at the Dow ETF under the ticker symbol DIA, affectionately referred to as the diamonds, July closed higher than the high of the previous month, and price continues to climb toward the previous high. Looking at the Nasdaq 100 ETF, or the triple Qs, we also have a new closing high, but with an upper wick on July's candle and a close inside the range of June's candle. The Nasdaq, with Facebook, has been an area of concern that we continue to watch. The current price action looks like a combination of consolidation within a bullish trend and sector rotation. We will continue to monitor the evidence for any signs of change. Looking at the IWM, or the Russell 2000 ETF, this index also had a very strong advance, and like the triple Qs, it shows signs of slowing, similar to what we saw in the previous chart. Again, when the market closes at a new high, it's telling you something, and it usually isn't bearish without other signs of bearish confirmation. The road to 3,000 is bound to be filled with some twists and turns. The key is to have enough knowledge to be a skillful driver and enjoy the ride. Stocks make new highs all the time, which is why prices move to the upper right on charts of the S&P, going all the way back to 1925. But it's human nature to worry about each new high, especially if you're not sure what else to look for to help you distinguish a new high from a top. Remember, tops take time to develop. Let's look at some signs of a top. The only areas that are currently signaling caution on this list are slowing momentum and the yield curve. Coincidentally, both of these areas usually provide about 18 months of lead time before the market peaks. We don't have a yield curve inversion at this time, but we did have a peak in momentum that we're going to look at. You see that widening credit spreads is asterisked. That's because we've been keeping an eye on the high yield space relative to government treasury bonds, but this is an area that's improving. Before we look at the momentum peak on the charts, let's define momentum. You can pause the video here if you wish and read the definition. Simply put, momentum is the rate of change in acceleration of price. After a significant rate of change in price, such as we saw in the run-up to the January high, it's to be expected that momentum would slow. That doesn't mean that we've reached a top, but it's a sign to be cautious and to look for other signposts along the way. This chart looks complicated, but it isn't. It shows three things. It shows momentum here in the top panel, price in the bottom panel, and I've added some vertical lines to show peaks. Peaks in momentum are shown in orange, and peaks in price are shown in red. Following peaks in price, we have downturns. In your car, you measure speed with a speedometer. Momentum is the rate of change in your speed. On charts, we often measure momentum with RSI, but RSI only uses one time period and is susceptible to giving bearish signals after particularly strong price advances. The ultimate oscillator, developed by Larry Williams in 1976, solves this problem by using multiple time periods. That's what we're using here in the upper panel. The value of this oscillator ranges between 0 and 100, with 50 being the center line. You can see that I've added this red line for the value of 80. The chart shows 7 vertical orange signal lines where momentum got above 80. After each signal, the market continued higher, for an average of 18 months before a significant decline. We got a signal in November of 2017, and the market peaked at the end of January 2018, and as we saw, has gone on to make a new closing high. Look at the left of the chart. The strongest peak on this chart occurs in 1954. So in a few slides, we're going to take a stroll down memory lane to compare the peak in 1954 to the present day. Why 1954? As we've shown many times in previous videos, going back from 1925 to present, there are 3 distinct periods of consolidation in price lasting between 16 and 18 years, followed by bull markets of similar length. 1954 is a few years into the bull market, like we are now. Remember, as we've covered in previous videos, we use cyclical lows to define the start of new bull markets. Memories of the 1929 crash were fresh, and those who grew up following the Depression were very reluctant to invest in stocks, much like millennials today who remember the crashes of 2000 and 2008. There are other similarities as well. Low inflation, low commodity prices, significant advancements in technology, and as we saw previously, 1954 had the strongest peak in momentum on our chart, so it's a good place to look for similarities and differences. Breadth wasn't an area of concern on our checklist, but it's an important indicator of when we're building a top. So we're going to look at that as well. To measure breadth, we'll use the NYSE Advanced Decline line, which is the black and red line. We'll also look at price in the S&P, which is the green line. Breadth is simply a measure of how many stocks are advancing in price, minus those that are declining. If more stocks are advancing than declining, the line is positive and it moves to the upper right. We want to see the majority of stocks advancing for a healthy bull market. Divergences that potentially foreshadow a top occur where the S&P goes on to make a new high and breadth does not. Before the dot-com bubble burst, breadth made a lower low, while price continued higher. Fewer and fewer stocks were participating in the advance, and the market peaked and then crashed. The same thing happened in 2007 before the housing bubble burst, and in 2015 before the 2015-2016 correction. So let's go back to 1954 when momentum slowed. At the end of the bull market that ran from 1949 to 1956, a divergence did occur that foretold the end of the bull market. After this divergence, the Dow peaked in April of 1956, and the market went into a significant decline. We did not have a bearish divergence leading up to the January 2018 high. Let's look at the 1950s bull market again with a ribbon of moving averages. We can visually see in 1957 where the moving averages rolled over and price dropped below all moving averages as the bull market ended. But were there signs on this chart before that? See if you recognize these from previous videos. After our signal that momentum was slowing, price becomes more volatile, making deeper and deeper incursions into the moving averages until price breaks through. Compare the previous chart to 2018. After a very strong advance in price, we correct in early 2018. Price moves well within the moving averages, but does not go significantly below and recovers. The moving averages compress, but don't roll over, and at the moment are beginning to resume their full bullish configuration. This is another area we want to watch for continued improvement as price from the correction begins to roll out of the moving average calculations. As with every individual piece of evidence, this could change at any time, which is why we use a model to evaluate a more comprehensive set of evidence. On a shorter time frame, we should also be cognizant of seasonality. August, and in particular September, are historically the weakest months for S&P returns. The back half of the year offers some of the strongest returns. We'll wrap up with a daily chart of the S&P. We're very close to taking out the January high, and as you can see, we were rejected at this overhead line of resistance and found support here. We'll simply have to watch the action next week to see if we trade within this range or if we continue to build on strength and break through resistance. The best plan is to have risk management in place, assess the probabilities, and react to the evidence the market gives you. Opinions may change, but you can't change price. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.